Welcome to the deep dive. We tend to operate under this collective assumption that the digitization of the modern economy was just a universal upgrade.
Right, like a rising tide lifting all boats.
Exactly. I mean, you move from paper ledgers to cloud-based systems, you replace mailed checks with instant wire transfers, and theoretically, all the friction in the commercial world just evaporates.
Right, that's the narrative we're all sold.
Yeah, but when you actually look under the hood of global supply chains and, well, corporate treasury departments, you find this massive counterintuitive
It's
paradox.
it's actually really shocking when you dig into it.
It really is. The transition to digital accounting didn't eliminate friction at all. In a very specific, deeply damaging way, it actually destroyed a centuries-old mechanism of trust.
Yeah, it broke something fundamental.
So our mission today is to dive into the source material. We've got excerpts from a really fascinating text here and unpack this hidden corner of the commercial world. We're looking at the evolution of working capital.
From the old restrictive methods to this new digital revolution that the sources call the magic box system.
Right, the magic box. And I want you listening right now to really picture this because it affects you. Whether you realize it or not, this invisible problem dictates the cost of the food on your table and the speed of global logistics.
Because it's all about what happens after you deliver a product. Right, you've done the hard work, but now you have to play this agonizing waiting game to actually get paid.
Exactly. And before we get to the magic box solution, we really need to set the stage here. We need to talk about working capital. Just briefly, what does that actually mean in this context?
Sure. So, working capital is basically the lifeblood of a business. It's the cash you need to just keep the lights on, pay your staff, buy raw materials, while you're sitting around waiting for your buyers to pay their invoices.
It's the gap money.
Exactly, the gap money. And the core tension here, which the text highlights so brilliantly, is how computerization initially hurt suppliers by making that gap infinitely harder to finance.
Right, which seems completely backward. But to understand the solution, we have to look at who is actually suffering here, right? Who is taking the hit?
Yeah, the two faces of the supplier.
Right. The text introduces these two extreme examples to show just how universal this vulnerability is. So, on one end, you have these unsophisticated subsistence farmer.
Right. Someone producing crops on a tiny plot of land, completely dependent on selling to a massive, centralized local buyer.
Like a massive food corporation.
Yeah.
And they have zero leverage. But then you swing all the way to the other end of the spectrum.
Highly sophisticated, modern supplier.
Yeah, exactly. We're talking logistics conglomerates with fleets of cargo ships, transcontinental trains, trucks, planes. They're servicing creditworthy blue-chip corporate buyers.
Huge operations. But the crazy thing is, despite the massive difference in scale, the subsistence farmer and the logistics CEO share the exact same fundamental vulnerability.
Which is just wild to think about.
Right. They both have this desperate desire to actually be paid for their production according to the arrangements they agreed on. And as the source notes, that is often just a pipe dream.
A pipe dream. Because the moment the goods are delivered, whether it's a truckload of sorghum or a shipping container of electronics, the supplier's leverage drops to absolute zero.
Exactly. You've transferred the value, and now you're basically acting as an unsecured, zero-interest lender to your own client.
Which brings us to the historical context, because this is where the paradox really hits. Let's talk about the accounting trinity, as the sources lay it out.
Right. The three traditional forms.
Yeah. So historically, you had the invoice, which says what you owe. You had the proof of delivery, which proves the stuff actually arrived. And then you had this third thing, the bill of exchange.
The famous bill of exchange.
But wait, here's my pushback, because I was reading this and thinking, the sources say computerization and digital payments actually caused the bill of exchange to fall into disuse.
Yeah, it basically killed it.
But shouldn't digital methods have made things better? Like an electronic invoice is faster, it's trackable. Why did losing a piece of paper hurt the supplier?
Well, it comes down to what that piece of paper actually represented. The bill of exchange wasn't just a notification of debt, like an invoice. It was a formal, legally binding promise to pay at a future date.
Like an IOU with real legal teeth.
Exactly. The buyer had to physically accept it, effectively signing a commitment. And because it was an ironclad promise, it had intrinsic value. A supplier could take that piece of paper to a financier, and they would eagerly lend against it.
Because they knew the buyer was legally on the hook.
Right. But when we digitized everything, we optimized for speed, not commitment. We kept the digital invoice, but we lost the formal, irrevocable digital acceptance.
So the buyer just gets this digital invoice in their inbox, and they can basically ignore it or dispute it or just drag their feet.
Precisely. The death of the bill of exchange heavily benefited the corporate buyers and the financiers, but it completely disadvantaged the supplier. It removed that ironclad future promise.
So obtaining credit based on just a digital invoice becomes incredibly problematic.
Because a standard invoice is just a claim by the seller. It's not a commitment by the buyer.
Yeah.
And traditional banks know that.
And the real-world stakes here are just brutal. I mean, we talk about payment terms and balance sheets, but the text really zeroes in on the human element.
Yeah, it's not just corporate metrics.
Right. If a buyer reneges on a 30-day payment term, it's a disaster. The seller has real responsibilities. Their staff rely on those salaries to pay rent, put food on the table, buy clothes, fund their children's education.
It's the entire local economy.
Exactly. The sources explicitly state that late payments actively scupper national and social well-being objectives. It's siphoning life out of the community.
And so because buyers are dragging their feet, suppliers are forced into this horrific waiting game. They have to find ways to survive the delay, which brings us to the traditional, heavily flawed ways they've historically raised working capital.
The working capital grind. I love that term. So let's look at the options. Option 1, supplier credit.
Right, the text notes this is generally considered the best kind of credit.
Basically, you ask the people selling you raw materials to give you 60 days to pay, right?
Yeah, exactly. You pass the delay down the chain. But the catch is, it's not always easy to get. And more importantly, suppliers can abruptly withdraw it for almost any reason.
So you could wake up one morning and your vendor says, actually, we need cash up front now.
And you're completely stranded. It's a house of cards.
Okay, so if that fails, you move to option 2, the bank credit gauntlet. And I read the description of applying for a bank loan or an overdraft, and it just sounds miserable.
It is notoriously difficult.
My analogy for this is, it sounds like asking a bank for an umbrella, but they demand you hand over the deed to your house just in case it rains.
That is a perfect analogy, honestly. Banks are fundamentally risk-averse. They look at your unverified digital invoices and they see nothing but risk.
Right.
So they demand what the industry calls belt and braces security. They want creditworthy guarantors. They want a bond over your fixed property.
Your commercial real estate or even your personal home.
Up to your personal home, yeah. And if you don't have property, they want a notarial general bond over your business's movable assets, your machinery, your trucks, everything. Unsecured overdrafts are practically a myth for a growing supplier.
Which brings us to the specific concept the text dives into, which just seems mathematically broken to me. The cession of outstanding amounts or the debtor's ledger. Can you break that down?
Yeah, this is the real bottleneck. So a banker will take a cession, meaning a legal security interest, over your entire outstanding debtor's ledger to cover your liabilities.
They claim all your unpaid invoices as collateral.
Exactly. But because they're acting highly conservatively, assuming lots of those invoices might be disputed or delayed, they only advance you a tiny fraction of that value.
Right. The text mentions they only grant up to roughly 20% of the outstanding ledger.
Just 20%.
And the so what here for you listening is that this 20% figure is mathematically insufficient for any fast-growing supplier. I mean, think about it. If you have 100 grand tied up in unpaid invoices and the bank only gives you 20 grand,
you can't even cover payroll, let alone buy materials for the new orders coming in.
Exactly. It actively forces them to look elsewhere because you can actually grow yourself into bankruptcy.
Which leads us to option 3, finance houses or factoring.
Right, the alternative. You go to a finance house that basically buys your outstanding invoices at a discount and finances future ones.
But the text is really careful to highlight a major caveat here. This only works if you find a finance house that acts as a true partner in your business.
Which is rare, right?
Incredibly rare, because when you factor an invoice, the finance house takes over the collection. So now, a third-party debt collector is harassing your best clients for payment.
Oh man, that destroys the relationship.
It completely ruins the commercial dynamic. You have to be incredibly careful in these relationships, and they charge steep fees to boot.
So we have a landscape where trade credit is fragile. Traditional banks demand 20% cessions and your firstborn child. And finance houses are a mixed bag that might nuke your customer relations.
It's bleak.
It is bleak. But this is where the whole narrative flips. Because a new technological option is emerging. The sources mention it started in South Africa, but is spreading further afield, and it aims to become absolute best business practice.
The digital renaissance of trust.
Enter the magic box.
Yeah.
So what exactly is the magic box? Because the text describes it as this incredibly accessible, standalone digital platform. It literally says just log on and away you go from a desktop or laptop.
Right. It's designed to be completely frictionless from a user experience standpoint, but its core function is profound. It takes an ordinary, unverified digital invoice, and it validates or confirms it for payment on a specific future date.
Okay, wait, how does that connect back to the accounting trinity we talked about?
This is the genius of it. It directly restores the lost promise to pay. It effectively resurrects the old bill of exchange, but in a digital, highly secure format.
By forcing the buyer to actually commit.
Exactly. Instead of a digital invoice just floating in the ether, the buyer uses the platform to indicate to the seller and to a financier exactly which day they will pay and what specific bank account will be credited.
Oh, wow. So it injects massive confidence back into the system.
Massive confidence. The ambiguity is surgically removed.
And that completely changes the game for the financier, right? Because instead of extending some risky 20% capped overdraft based on hopes and dreams, the financier logs in and gets to see a listing of unpaid invoices that represent bona fide, confirmed commercial trade.
Right. They aren't underwriting the supplier's messy operational risk anymore. They're looking at a discrete, undeniable promise from a creditworthy buyer.
The financier is totally in the driver's seat. They can just select exactly which invoices they want to finance. They know the exact date it will be paid, and they control the bank account it flows into.
It's a financier's dream scenario. Total visibility, zero dispute risk.
Okay, I want to walk you, the listener, through exactly how this works in practice. Let's do a deep dive into scenario A, which the text outlines as the supplier-driven flow. Let's look at it step by step.
Sure, so the prerequisite here is that everyone has to be in the ecosystem. The financier, the buyer, and the seller all register with the operator of the magic box.
Creating this digital ecosystem of transparency, the sources call it a scheme of arrangement.
Right, so let's use the 100,000 Rand example from the text.
Perfect. Step one.
Step one, the physical goods, the original invoice, and the proof of delivery move from the supplier to the buyer just like normal. Nothing changes in the physical world.
So the trucks still roll, the boxes get dropped off.
Exactly. Step two, a copy of that electronic invoice flows directly to the Magic Box platform.
Okay. Step three.
The Magic Box automatically pings the buyer. It essentially asks, is this genuine? Are the goods okay? Is this amount due and payable?
And this is the magic moment, right? Step four.
Step four, the buyer says yes and schedules the payment for a specific locked-in date. That confirmation flows back to the Magic Box. The asset is now validated.
It's basically a digital bill of exchange now.
Yes. So step five, the Magic Box offers this now confirmed invoice to the network of financiers.
And step six, a financier chooses to finance it. They see this pristine, validated 100,000 Rand invoice, and they grab it. The text also notes that this trade can be insured if needed, right?
Yeah, credit insurers can be layered on top for even more security.
Okay, let's break down the actual financial mechanics of the payout, because this is where the math gets really elegant compared to the old 20% bank session.
Right, so the financier debits their facility account, they immediately take off their financing fee and whatever the interest charges are for the waiting period.
But there's a crucial detail here. They also hold back what's called a safety net retention amount.
Yeah, this is important. Even though the invoice is validated, there's always tiny macro risks, like a bank routing delay that takes an extra day, or unforeseen cross-border friction.
So the retention amount is just a small buffer to protect the financier's yield.
Exactly. But unlike the bank that holds back 80%, this retention is small. The remaining working capital, the vast majority of the 100,000, is credited directly to the supplier's bank account that same day.
Incredible. And then on the due date.
On the exact due date, the buyer pays the full 100,000 directly to the financier's controlled account. The financier keeps their principal and fees, and then automatically releases that safety net retention amount back to the supplier.
To summarize that, the supplier gets the money they desperately need to live and grow, the financier gets an incredibly safe, predictable return, and the buyer gets to maintain their payment terms.
It's seamless.
But what if the dynamic is reversed? Because the text dives into scenario B, which I found fascinating. What if a buyer actually wants to help their unsophisticated suppliers get paid quickly?
Yeah, this happens a lot when buyers realize that starving their supply chain of cash is a massive operational risk to their own business.
Let's bring in the specific example from the text. You have an unsophisticated supplier selling sorghum to a massive corporate brewer.
Right.
The brewer desperately wants to keep their supply sources regular. They need that sorghum. They want to pay early to keep the farmers healthy, but, and this is the classic corporate treasury problem, sometimes their own inward cash flow or their DPO metrics prevents them from doing this out of pocket.
Right. The CFO doesn't want to use the company's own cash to act as a payday lender for hundreds of farmers. It's an inefficient use of capital.
So we get the reversed magic box flow. Break this down for us.
Okay, so in this reverse flow, step 1, the brewer proactively selects which supplier invoices they want paid quickly. These are unpaid invoices that are already scheduled in their creditor's register.
They pre-validate them, essentially.
Exactly. Step 2, copies of these pre-validated invoices flow to the magic box.
Step 3.
The magic box proactively contacts the supplier. It sends a message to the farmer, basically saying, your buyer has approved this. Do you want to be paid early, less a small discount fee?
And obviously, the farmer says yes.
Right. So step 4. Once validated by the supplier's opt-in, the invoice is offered to the financier.
Step 5. The financier pays out the supplier immediately, deducting their charges. The farmer has cash in hand instantly.
Step 6. The financier then just waits out the agreed term, say 45 or 60 days.
And finally, step 7, the brewer, pays the financier at the end of that normal term.
The beauty of this is that the buyer didn't have to use a single cent of their own working capital to stabilize their supply chain. The financier provided all the liquidity secured by the buyer's promise.
It fundamentally re-engineers the whole ecosystem. Which brings us to the ultimate consequence of digitizing and securing working capital this way. The text basically tallies up the final score for all the players, and it's an overarching win-win-win-win scenario.
Yeah, let's break down those victories.
Let's start with the supplier. I mean, they are delighted, right?
Delighted. They never have to wait or, frankly, beg the buyer for payment ever again. They get paid early. They can proceed with their business, buy new equipment.
And as the text specifically, and somewhat humorously notes, they can keep his wife pleasantly surprised as well.
Right. It relieves all that household financial anxiety.
Exactly. It's a massive win for human well-being. Then you have the win for the buyer.
They get a perfectly healthy supply chain. The suppliers are totally off their back regarding payment statuses.
No more angry calls to accounts payable.
None.
Yeah.
And structurally, the buyer can sometimes even push off their own payment date by a few extra days to manage their internal cash flow better because the supplier already got paid by the financier.
It's brilliant. Okay, the win for the financier.
They earn their usual interest revenue, plus a financing or arranging fee, all while operating in a highly secure digital environment.
Based on real validated trade, not a guesswork or risky sessions.
Exactly. The risk profile drops off a cliff.
And then there's the final win, which is for the country. I mean, taking a macro view here.
Yeah, this is the most profound part. When productivity, meaning the ability to raise invoices on creditworthy buyers, is effectively financed without these crippling 60-day or 90-day delays, the entire economy speeds up.
The velocity of money increases.
Exactly. The farmer buys a new tractor, the tractor salesman buys a car, the car dealer expands his lot. As the text explicitly states, when this friction is removed, soon prosperity will abound.
Prosperity will abound. I love that phrasing. So, to recap this incredible journey for you listening, we started with the universal vulnerability of both the subsistence farmer and the massive fleet-owning logistics supplier.
Trapped by the death of the old bill of exchange.
Right. Then we waded through that highly restrictive era of banks demanding 20% cessions and your house as collateral.
The working capital grind.
And finally, we arrived at the elegant digital trust of the Magic Box, a system that uses modern connectivity to essentially restore the old ironclad promise to pay.
It's a perfect full-circle evolution.
It really is. And I want to remind you, whether you are a buyer, a seller, or a financier, understanding these hidden mechanics of working capital is the key to understanding how the global economy actually breathes.
The plumbing of the commercial world.
Exactly. And just a note, if you want to get started with this kind of system, you can contact the businesses listed in the text's resource box. But before we wrap up, I want to leave you with a final lingering question to mull over.
Yeah, I think the biggest takeaway here is philosophical. We've seen how a new piece of technology, this magic box, was used to essentially resurrect a centuries-old concept of trust, the physical bill of exchange.
And using the new to bring back the old.
Exactly. And it makes you wonder, as we move further into a fully digital, highly automated commercial future, How many other modern business problems are really just waiting to be solved by using technology to bring back old-fashioned human accountability?
Wow. Are we just reinventing the handshake and code?
Pretty much.
That is a fascinating thought to leave on. Thank you so much for joining us on this deep dive.